Let's look at, we have looked at the direct tax. So the direct tax will be the tax on corporate profits or on capital gains or on an individual's income. Then indirect tax. So this is a tax charged on one part of the economy with the intention of it being transferred to another. Right. So there are different types of indirect taxes. So one would be a specific or unit tax, a tax that are based on the weight or size of the tax base. So for example, let's say a country says every liter of alcohol there will be a $5 excise duty. So that becomes a specific or unit tax. Or $1 per 100 grams of tobacco, that is also a specific or unit tax. Then you can have something called ad valorem tax. This is where the tax is calculated as a percentage of the sales value. For example, a 5% sales tax will be an ad valorem tax. So a tax which is 5% of the selling price. Then the main consumption tax will be the value added tax. Now when we talk about consumption taxes, the economic activities in a country, we can divide it into three levels. There will be the manufacturing level, the wholesale level, and the retail level. So a tax can be a single stage sales tax, a single stage sales tax. This is where the tax will be applied either at the manufacturing level, wholesale level, or at the retail level. It is applied only at one level, not at all three levels. Then it is called a single stage sales tax. Now this is not very common. Now USA is one example for a country which uses a single stage sales tax. Then we can have a multi-stage sales tax. That means you have the manufacturing, wholesale, retail. At each level there will be a tax. So this multi-stage sales tax can be further divided into two. One is called cumulative or cascade tax. Cumulative. That means if the tax is applied at the manufacturing level, then another tax will be applied at the wholesale level and another tax will be applied at the retail level. So it gets added on, cumulative or cascade tax. So there will be tax on tax. Then the other multi-stage sales tax is the value added tax. Right. Let's look at how does this value added tax system works. It can be the rates of tax will be provided to you. It is mainly charged, the tax burden will be with the final consumer, and this is how the VAT system works. Now value added tax, for simplicity we call it as VAT. Right. There are organizations that are not registered for VAT. What do we mean by that? An organization that is not registered for VAT means a small business generating a small sales revenue. Now when I say small, there is what we call as a tax threshold. So the tax authority will say if your sales are below a specified value, you need not register for VAT. So this is essentially for small businesses. Right. Now if an organization is not registered for VAT, what is the implication? So if you are not registered for VAT, whatever you sell you will not charge VAT. On your sales, there's no VAT. So if an organization that is not registered for VAT sells an item for $1,000, then the customer will pay only that $1,000. There's no additional value added tax being considered. But if the organization is not registered for VAT, and when they buy goods, when they buy an input, if they have paid VAT, they will not get a refund of the VAT paid. So then the input VAT, when you went to buy raw materials, if you paid VAT, you will not get a refund of that VAT paid. So that is in case of the organization being not registered. Right. Then if you look at the organizations that are registered for VAT, so any organization generating a sales revenue or sales value more than a specified amount or more than the threshold, it is compulsory for such organizations to register for VAT. Right. So these organizations that are registered for VAT can be divided into 4. It can be standard rated, it can be 0 rated, it can be exempted, it can be higher or lower rated. So let's go through one by one. Now, before looking at each of those, if the organization is registered for VAT, the sales invoice we issue should contain certain information. We call it as a VAT invoice. So the organization should issue a VAT invoice. If you are registered for VAT, you have to keep all the records for a specified time period. For example, in the UK, you have to keep the VAT records for 6 years. Then whatever the items you sell, you have to charge VAT, and every quarter you will have to provide the details to the tax authority regarding the VAT transactions. Right. Then the transactions that are liable to tax or to VAT. So the organizations that are registered for VAT can provide goods or services that fall into 4 categories. Standard rated. Now, how does this work? What is the standard rate? Your examination question will say whether the standard rate is 10%, 15%, 20% or 25%. Right. If an organization is selling a standard rated item, then to the selling price, VAT should be added to arrive at the selling price. So if the standard rate is 10%, if the sales is 1,000, if our selling price is 1,000, to that we add another 10% and charge the customer 110. So this VAT on sales is called output VAT. Now this output VAT collected by an entity is a liability. Why? The organization has collected it on behalf of the government or the tax authority. So the amount of money collected as input VAT will be considered as a liability. Then if a standard rated organization or an organization selling a standard rated item paid VAT on their inputs, then the amount of input VAT paid or VAT on purchases can be set off against VAT on sales. The net amount should be paid if the output VAT is more. If the input VAT is more, then the tax authority will give a refund to the organization. Then organization can provide goods or services that are subjected to VAT at a higher rate or lower rate than the standard rate. So that is the second one. So if the standard rate is 10%, if a particular item is to be subjected to VAT at 20%, that is higher rated. If it is to be 5%, then it is lower rated. So an organization providing higher rated or lower rated items will charge VAT on their sales, and also if they have paid VAT on their inputs, on their purchases, they can set off the input VAT against the output VAT. Then zero rated. As the name says, VAT is applied but the percentage is zero. In other words, VAT on output is zero. But if the organization is supplying a zero rated item, what we sell is subjected to VAT at 0%. What we buy, if we paid VAT, we can get a refund of the VAT we have paid. Then, if we sell something which is exempt, as the name says, no VAT on what we sell because it is exempt. But if the organization is selling an item which is classified as exempt, any input VAT we have paid at the time of purchasing, we will not receive a refund of the VAT paid. So zero rated, what we sell is charged VAT at 0%. Any input VAT we get a refund. If it is exempt, what we sell is not charged, there's no VAT on what we sell. If we have paid VAT on what we buy, we will not get a refund. So technically it looks the same as not registered, but this is a large firm registered for VAT. Yes, do agree that the treatment is same as an organization that is not registered for VAT. Then, if you look at, this is what I explained, exemption and zero rating, both output VAT nothing. Input VAT, if you're zero rated, you can get a refund. If you're exempted, you cannot get a refund. Right. Then, property tax. Organizations might be taxed based on the value of the property. So, the tax can be based on the value of the property or something called annual rental value. So at what value can you rent it per annum? Part of that can be the tax. So property taxes can be based on the value or based on the annual rental value. Then wealth tax. This is another indirect tax where the tax base is the wealth of the individual or the entity. Now, wealth is something which is difficult to quantify. Especially, a person can have an insurance policy. So, what is the value of the insurance policy? It depends. If the person registered lives till the maturity, they will receive one amount. If the insured doesn't live till the maturity, then the beneficiaries can receive double the value, triple the value, so it depends. So, in such a situation, what is the value of this insurance policy? Or, an individual might hold antiques, something, let's say a stamp collection, a coin collection which can be of high value. So, how do we measure the wealth? But the government can charge tax based on their wealth. Right. So, these wealth taxes can be on individuals, it can be on entities, and it can be on individuals as well as on entities. Then we can look at employees as taxation, as a base of tax. Right. See, from a government's point of view, when people are employed, they earn their salary or their wage. So the government can say, look, we are going to charge tax based on your income. Now, employees are a separate taxable person where they can be subjected to income tax or employment tax based depending on the how each employee is to be paid. Then, how will an individual employee be assessed for tax? Now, different countries have different rules. So, you are not looking at any country specific, but for example, a country like UK will charge tax in the current year based on the income earned or received during the previous year. Sorry, in the UK you are being taxed based on how much of income you earned during the year. Then in a country like France, you will be taxed based on previous year's income, or a country like Switzerland, they will tax you based on the average income for the last 2 years. So you don't have to worry what is the tax system in your country, because none of the questions will test any country specific. Right. So as an employee, what you earn as an income, if you are going to be taxed, aren't you going to be allowed to deduct certain expenses? Because you as an employee will say, look, a company is taxed not based on their sales but on their profit. So an employee is also allowed to deduct certain items. Let's look at what are they allowed to deduct. Some of them can include professional subscription. Now, as a CMA student, or you will have to pay annual membership. So from your employment income, they can let you, the tax authority can let you deduct your professional subscription. If you have a donation, if you provide a donation to a charity from your employment income, that the tax authority can let you deduct. If you are contributing to retirement annuity premium for a retirement scheme, that they can let you deduct. Then contributions to a personal pension plan, right? When you stop working, you're getting a pension, so your contribution towards this, there can be, that amount can be deducted. Then cost of security assets, certain assets might have to be provided as security based on the type of employment you're involved in. So that again, the cost of it can be deductible, right? These are some examples, right? Then if you're employed, there can be something called benefits in kind. So an employer, without paying cash or in lieu of cash, they can provide further additional benefits. They can give credit tokens, free fuel, free vehicles. So the tax authority can consider these benefits in kind and assess it or tax even the benefits in kind. Because tax authority will look at it and say, look, this is an attempt to stay without paying taxes. So all the benefits provided will be considered as income and it can be subjected to tax. Right. Now, some of the benefits in kind might be exempted in a particular country, so you don't have to worry about specifics like in the UK relocation cost, restaurant or canteen facilities provided. So these are specifics, so you cannot be tested on specifics regarding a particular country. This is just for us to understand. I have included this. Then again, specifics to UK, right? If you get beneficial living accommodation, vouchers, credit tokens, right? All these will be taxable. These are benefits in kind you receive. Then, if you look at how can the employees be taxed? The most common tax system is called pay as you earn, which is called as PAYE, right? Now, see, if the country has a PAYE system, it can provide benefits to the employer as well as to the employee as well as to the government. Let's look at each one. Now, if you look at from the government's point of view, a PAYE system, they will collect the tax component every week or every month. So, from the government's point of view, their cash flows are collected at regular intervals rather than collecting it at the end of 1 year. Then, this also provides a benefit to the individual because you don't have to pay large sums of money at once. Every time you earn your salary, the tax will be deducted and you get the net amount to your hand. So you don't have to make large payments as tax. Then, from the tax authority's point of view, a PAYE system, the employer has to maintain records, deduct the taxes, pay the net amount to the employee and the tax to the tax authority. So the cost of administration will be totally with the employer. So that results in an efficient tax system from the government's point of view. So these are some of the benefits to the employer, to the employee as well as to the government if there is a PAYE system.